Welcome back. Let's talk markets, sectors, how you should construct your portfolio. Christy Mathai, Equity Fund Manager at Quantum AMC, is now with us on the show. He manages the long-term equity value fund for Quantum AMC, and there's also an ELSS fund that you look at. But Christy, I wanted to get your thoughts in on equities first. I remember from the previous conversations and how Quantum AMC had constructed their portfolio, there wasn't too much of an exposure to the traditional FMCG names like your Britannia, Dabur, and here the numbers have started looking up. Q4 has been pretty impressive for the likes of Britannia. They're talking positive about rural demand. Is it time to now start allocating to the traditional FMCG companies?
Yeah, thanks, Reema, for having me. So to begin with, if you want to look at FMCG as a sector, pre-COVID, these have seen multiple re-ratings, especially modest growth, but the valuation had run up in most of these names because they kind of did well on margins. But now, when we are post-COVID, the situation seems to be a bit different. What we have seen is the inflation-led impact has kind of resulted in some sort of downtrading in most of the sub-segments. Also, there is rise of competition, especially from the unlisted players in some of the regional markets that they operate. And so we have seen kind of a dull, recovery post that phase. FMCG, if you were to just look at from ROE and all the financial parameters, looks absolutely fantastic, albeit for the modest growth that it offers. But valuations still for us, remains that bit higher. We have not had FMCG for a very long period of time. But if the situation prevails, the sector can also look interesting going forward.
Christy, hi. I mean, since we're talking consumption, just some more color on this. I mean, what part of this are you convinced by? Because, for instance, I mean, look at what a stock like Britannia is doing, and it's reacting entirely to the management's commentary. That company's management sees recovery. But you look at the other side of consumption, discretionary consumption, stocks like Titan. I mean, this jewelry segment, it's been a big wealth creator, right? Jewelry stocks overall. But that's where managements themselves are admitting that there is very high competitive intensity and margins could be under pressure. So how are you cutting up consumer? Just give us some more anecdotes into what you like and what you're staying away from.
Right. So if you were to look at jewelry per se, there could be certain influences, given where the fact the gold prices are. But according to us, this is largely seasonal. And, there is competition coming up as well in some pockets. So that remains an area which, there could be some near-term issues. But from a longer-term perspective, that still remains, a fantastic franchisee to own. But here also the valuation in our sense is, perhaps stretched. You're looking at perhaps for a broader sector as a whole, 12-15% EPS growth, give and take, and the P's are upwards of 60-70 times. There is the whole other segment within rural where I spoke about the downtrading, and this is pretty acute here because we have seen marginal players come up, especially with, the pricing being passed on to the end consumer by some of these FMCG majors. What we are seeing is this competition. People are downgraded and there is regional competition as well. So that remains, a challenge sector. But we are hopeful that the mass consumption at some point in time would have to pick up. So if, if you were to select from the broader sector that is available, that remains our preferred play. But, valuations would have to come down a bit for, for us to enter there in as well.
Kotak Mahindra Bank, I think, was one of the stocks that you held in your portfolio. Today, of course, the stock is doing well. Investors are finding value, at current levels. I think just 1.6 times forward price to book. But what have you made of the exit of Manya and the regulatory clampdown?
Right. So I wouldn't want to talk stock specific, but, private banks, including the stocks you mentioned, remains fairly on a stronger footing. There are some of the regulatory supervisions we cannot anticipate, and that might have that will come, in some of the stocks. But if you were to just think about from a longer term perspective, what we are seeing is fairly benign credit cost environment. We are seeing an uptick in credit, although deposit is challenged in a bit. But what we think is, if you were to talk about 1 year out or 1.5, 2 years out, this deposit challenge will also slowly go away. So net, you're finding some of these private banks with fairly attractive valuations. And, change of guard is always, makes the situation tricky. But given the history of long-term outperformance, especially in the asset quality, stable growth, we don't think there is much to complain in terms of, if you want to take that step. So this, as a sector, remains quite attractive in our view, and we've been incrementally adding to most of these names.
Thank you very much, Christy, for joining in. Look forward to more conversations.